Right, I hope you're enjoying this series so far. So welcome to yet another video. So in this video, I'm gonna just quickly, let's start here. Let's start with some foundational truths that I came to discover over time, right? So have you ever opened a trading terminal for the very first time, okay? Then stared at the charts or at your screen, there's flashing red and blue numbers and you felt intimidated almost immediately. You're not sure exactly what's going on and you're just overwhelmed, right? If you ever looked at the currency quote and wondered why are there two different prices listed side by side, or why your trade instantly starts in the negative whenever you hit buy or sell, then trust me, you're not alone. So if you've ever felt the sting of maybe entering a trade, getting the direction right, but still losing money because you didn't really understand the pricing of it, on the mechanics of it, you know exactly what I mean, right? So drop a comment down below if you've ever found yourself caught up in this confusing loop, because we're going to demystify this as we progress in this series and in this video. So here exactly lies the real problem for most retail traders, right? So when we try to master complex technical indicators before we even understand the basic mechanics of how currency quotes are priced, then we get confused in this whirlwind of over-information, right? And over-anxiety, okay? And then we just end up losing money over and over again. So the cost of operating in the dark, well, it's a big cost. And let me tell you why. Because let's look at the agitation of this particular mistake that we tend to make. We come into the markets thinking we can make money overnight. So when you click buy or sell without understanding how price is quoted in the markets, you're essentially walking into a business transaction without really knowing the price tag of what it costs to do business. So the immediate cost of this is death by 1,000 cuts. You enter trades at horrible prices or at horrible levels, not understanding why exactly prices are at that level. You let your broker also cool a part of your profits or dig into part of your profits with all these hidden transaction fees, spreads, commissions, etc. You don't understand how they work. And then this just intensifies your anxiety experience because you just can't calculate your actual risk and factor in all these hidden costs that are involved. So if you decide to go on holiday to the US, to Europe, or maybe South Africa, can you buy goods in that country using your local currency or like a Kenya shilling? Of course not. You have to physically exchange foreign currency to a local currency. So for my example, exchange my Kenya shillings for dollars or euros or South African rand so that I can be able to transact in that country. So then that brings a fundamental realization here that you can never trade a single currency in isolation. Every single transaction in the Forex market is a simultaneous exchange of one currency to the other. So you're buying one currency while selling the other. So this is why currencies are always quoted in pairs, just like the Euro USD, the Euro against the dollar, GBP USD, which is the Great British Pound against the dollar, or USD JPY, which is the Japanese yen against the dollar. So again, let's look at the anatomy of a pair and what makes up a pair. So to read a quote like an institutional player, I think you only need to understand one very simple rule, that there is one base currency and the other one is a quote currency. The base currency is the currency that comes before the slash. The quote currency is the currency that comes after the slash. So the base currency is the one that you are buying and the quote currency is the one that you are paying with. Let's take a very simple example. Looking at Euro USD, the euro is the base currency and the dollar is the quote currency. Then to understand this even further is that the base currency is always 1 unit of the quote currency. Base versus quote, base versus quote. Okay, so then how do we read these exchange rates so that it makes sense to us? So let's test this logic here with you. If the base currency on the left is always equal to one exact single unit, how should we read the exchange rate on the right? How do we interpret that information? Exactly. So the exchange rate simply tells you how much of the quote currency you need to pay to buy just 1 unit of the base currency. So if you see a quote of GBP USD at 1.2122, it means that the British pound is the base unit here and the US dollar is the quote currency here. So then it costs $1.2122 of the quote currency to purchase 1 unit of the Great British Pound. Speaking like a trader? Yes. So again, base currency is always one single unit. Quote currency is always the number of units or the price you have to pay to buy one single unit of the quote. That makes sense? Okay, let's dig a bit deeper into more financial jargon, right? So I bet you've heard people talking about I'm going long, I'm going short, maybe I'm square. If you watch some of these financial movies, maybe Wolf of Wall Street or The Big Short, you'll hear people saying long, short, etc. Right? So now that we agree on how a pair is structured, let's look at how professionals describe their market bias. So we can look at the market terms, what it means, and then the market view of what it means, right? So going long means you're buying the pair. Going long means you're buying. You expect the base currency to strengthen against the quote. So if we're expecting the base currency in GBP USD to do well, then we are going long the British pound, which means we are buying GBP USD. What happens if we are going short? If someone says they're going short, then we are selling the pair. So we expect the base currency in GBP USD to weaken, hence we'll be selling GBP USD, hence we are going short. If we are flat or square, we have no active trades. We're just sitting on our hands. Like today is another one of those days where GU and EU had really rallied yesterday, and we are currently consolidating at the top of that range. So we're just sitting on our hands and we are flat today. No active trades. We're waiting for price to come back to our area of interest so that we can we can look for any opportunities to get involved. So again, if you're flat or you're square, you have no open trades, you have closed all your exposure to protect all your capital, because remember, capital preservation is what we are focusing on. We are risk managers. We don't want to just be risking our monies anyhowly by guessing in the markets. So let's look at another major point of confusion, especially when it comes to brokers. So why is it that when you open your trading platform, why does the broker show you two different prices? So if you open your MT5 on the broker of choice, you will see that there's a blue line and there could be a red line that keeps on moving up and down, and you're wondering what exactly is going on. I think to understand this, think about maybe a car dealership, okay? So if you buy a car from a dealer and try to sell it back to them 5 minutes later, you've just gone outside. In fact, you turned it on, went outside the gate, and then you came back and you said, no. I want my money back. I'm selling this car back to you. Will they buy it back at the exact same price that you paid? Absolutely not. And why is that? Because they buy low and they sell high. So your broker operates on the same model. It's business, right? Your broker will have something called a bid price. Okay, so the bid price is the price that the broker is willing to buy the base currency from you. It is your selling price. Okay, and it is always the lower price of the two numbers. Let me take that one more time. The bid price is the price that the broker is willing to buy the base currency from you. It is your selling price, and it is always the lower of the two numbers. That's the bid price. The ask price is the inverse, which is the price that the broker is willing to sell to you, and it is always slightly higher than the other number. So if the broker is buying low, which is the bid, and selling high, which is the ask, what happens to the tiny difference between these two prices? Well, that difference is what we call the spread. Maybe you've heard of this term before. If you haven't, welcome to Forex 101. So the spread is the broker's commission for facilitating your access to the global markets. Remember, the broker is like a wholesaler. They go into the global markets, buy in wholesale, then come, put up a markup, which is the spread, and then they sell it to us as retail traders via the broker platforms. And that's how they kind of make money. This could explain why, and I know that you might be thinking this, the moment I click buy or sell on a trade, I will automatically start a fraction of a dollar in the negative. It always starts negative, never starts positive. Yes, what you're thinking is correct, because this is the spread in action. You must accept this as it's just a cost of doing business. So the broker takes on their commissions or their spreads just for allowing you to access the markets. So anytime you hit buy or sell, if you notice, if you're keen enough, you'll see that you'll start at a very small negative. If the market moves in your favor, then now you start moving into profit or in the money. So because you buy at the higher ask price, again, we're back to bid and ask price. So remember, bid price is the price that the broker is willing to buy from you. Then the ask price is what they are selling it to you for. So because you're buying at the higher ask price is always higher, but have to sell at the lower bid price to exit your position, the market has to move in your favor by the width of the spread, the distance between those two lines that you keep seeing, one blue, one red potentially, before you actually hit your net profit. So then professional traders don't complain about this. You might think it's a bone of contention and why you might not want to be involved. But again, different brokers have different spreads, and this is something you will get to understand more, and we'll cover in our How to Choose a Broker and How to Choose an Account series. But for here, professional brokers, again, it's a cost of doing business, just like any business. So professionals don't complain about the spread, they manage it. They choose low spread currency pairs and avoid trading during highly highly illiquid market hours, especially when the broker widens the spread to protect themselves. So you'll notice that when we get into our live trading sessions, you'll notice that in some sessions, some pairs and some sessions have higher spreads, other sessions have tighter spreads. We'll get to understand how to choose the right ones. Okay, so then understanding how to read the base quotes and quote currency and also understanding spreads is a good foundation to understanding how to execute professionally and also be in the game long term and not just guessing your way through the trading business. And also, if you agree that trading is a business and treating it like a business is the best way to build sustainable wealth over time, then our very next step is learning how to calculate these shifts in these microscopic levels. So in the next chapter, we're going to dive deep into what exactly is a lot or lots, what is leverage and how to use it, and what is margin and how to interpret it. And all this will be showing you exactly how to calculate all your exposure, how much you're risking and how much you're willing to lose, how much you're going to make as a profit, and then structure your positions and your sizings so that you never risk more than you can afford to lose. That is fundamental because capital preservation is our number one priority. So again, hit that subscribe button, keep your risk parameters very tight and in check. If you're still a beginner, don't rush to put money into the markets. Invest in your education first, and let's keep executing. So again, our goal here is to earn in dollars and spend in Kenya shillings or our favorite local currencies. I'll see you in the next video. Cheers.